So towards the end of May, Fry put a stake in the ground. Wall Street was saying the S&P 500 was going to 8,000 by the end of the year, whereas Fry believed the weight of evidence pointed the other way, materially the other way. 54 days have passed, and today we'll mark these forecasts to market, because a forecast not revisited is not a forecast, it's an advertisement. Think about that. An advertisement. Two things have happened since May, and they have happened in opposite directions. The banks have raised their targets while the market has fallen. Think about that. It's the entire presentation in one sentence. The scorecard, 26 May to 17 July. The numbers first, because we are imperatists here. On the 25th of May, the S&P 500 stood at roughly 7,547. Last Friday, it closed at 7,458, down about 1.2%. The Nasdaq composite has gone from roughly 26,293 to 25,545, down nearly 3%. Meanwhile, the median year-end target across 19 Wall Street firms has risen to 7,850. So, the professional consensus has become more bullish while the tape has become weaker. That divergence between narrative and price is precisely the condition the Doctrine is built to exploit. In the background, the geopolitical machinery has turned exactly as our model anticipated, and then some. The US-Iran memorandum collapsed on the 8th of July. The naval blockade was reinstated on the 14th. Tehran has now instructed the Houthis to stand ready to close Bab el-Mandab. Both choke points of the double disruption thesis we covered earlier are live at once, and Brent has answered. Roughly $88, up some 12% in a single week, its third consecutive weekly gain. And Friar strongly believes it has a long way to go. Okay, looking at the table. Morgan Stanley, 7,800 in May, raised to 8,000 now. JP Morgan, 7,500 in May, 7,800 now. And remember, back in March, JP Morgan had actually cut to 7,200 and warned of 6,000. Wells Fargo has arrived at 7,950, telling us it's profits, not policy easing, stupid. Only Bank of America at 7,100 is willing to say the quiet part, that valuation and liquidity matter, and that the market needs earnings rather than multiple expansion. In other words, forecast earnings need to be checked carefully. As a former economics lecturer, Friar cannot resist the footnote. Micheli and Womack in 1999 documented the structural optimism bias in sell-side research over a quarter of a century ago. The conflicts of interest are institutional, not personal. When targets are raised into a declining tape, the bias is on full display. And here is the useful corollary. The higher the consensus climbs while price refuses to follow, the greater the informational value that refusal. How often have you seen a portfolio manager being interviewed on CBS or whatever the stations are, Bloomberg, etc., saying, Jesus, get out of the market, cash in our stuff, get out, Doubtful. One chart, every number that matters. At the top, Goldman and Morgan Stanley at 8,000. At the bottom, Friar's weighted central range, 5,500 to 6,400. And in between, the market itself at 7,458, sitting closer to our range than theirs with every passing week. Friday's session was the tell. The S&P fell 1%, the Nasdaq 1.5%. The VIX jumped 11%. Semiconductors were routed. The media blamed AX CapEx doubts. IBM collapsed 25% on software demand. Micron had already dropped 8% earlier in the week. And while equity sagged, Brent pressed past $88, up 12% on the week. WTI going past 81 and gold above 4,000. Equity weakness into commodity strength. That's the stagflationary signature. And it's the environment in which multiples compress. Even the good Mr. Buffett felt moved to observe that the market has become a casino of speculative preference. When the sage of Omaha and the tape agree, Friar pays attention. You've heard Friar rabbit on about Peter and the Wolf. Every ceasefire headline, every memorandum of understanding or misunderstanding produces an algorithm-driven relief rally, and none of them resolves the physical constraint, the fundamentals. The 17th of June, MOU signed, machines buy. The 7th of July, US Treasury revokes the license permitting Iran oil sales after attacks on tankers, including Qatari LNG carrier. Brent jumps 5%. The 8th, the MOU collapses. The 13th, the Houthis strike at Saudi Arabian airport and crude spikes 6% intraday. The Red Sea front reopens. The 14th, the naval blockade is reinstated and Hormuz transit is rated severe. The 16th, Tehran instructs the Houthis to stand ready to shut Bab el-Mandeb should American strikes reach Iranian power infrastructure. By week's end, Brent has gone past $88. It's up 12% in 5 sessions. Now mark the structural point, because this is the double disruption thesis arriving on schedule. Saudis have been rerouting export volumes through the Red Sea precisely as its alternative to Hormuz. If Bab el-Mandeb closes, Saudi Arabia loses its primary and its backup corridors simultaneously. There's no third road. Some people mention pipelines. Pointless. Israel might, but certainly Iran would just bomb them. That compounding is why the escalation scenarios now being circulated on the sell side run to $120, even $150 Brent. I hope so. I will make money, a lot of money. In the language of our framework, the A variables, the headlines, get priced, unpriced, and repriced by the algorithms within minutes. The C variables, the physical flows of oil, gas, fertilizer inputs, bromine and helium through the world's 2 most important choke points, never went away. The fundamentals remain. Each time the wolf cry proves false, the market's credibility discount on the next piece headline grows. That is Peter and the Wolf, Chapter 3, and the book has more chapters in it yet. So Friar's portfolio scenarios to the 30th of December 2026 reaffirmed. The May scenario table unrevised. Bear case, 50% probability. S&P 5,800 to 6,200. Deep bear, 25% chance. 4,800 to 5,500. The bull case gets its honest 25%. Or 20%. If the war genuinely resolves and the Fed eases without reigniting inflation, 8,000 is achievable. And intellectual honesty demands we say so, even though the Friar doubts it very much. The weighted central estimate remains at 5,900 to 6,400 on the S&P, and 19,000 to 21,000 on the Nasdaq. 54 days is nothing against the next 5.5 months. But the direction of travel matters. The tape has drifted towards the bear path, not the bull path. Schiller's 1981 showed that prices move far more than subsequent fundamentals ever justify. The correction of that excess does not run to anyone's calendar. Hence the discipline you have heard Friar repeat since the beginning, early not wrong. We do not need the market to agree with us today. We need only to be positioned with defined risk when the time is ready. Okay, here you can see Friar's current positions. QQQ Bear Leap, January 2027 at 560. A put. Direct expression of tech multiple compression. And Friday's Nasdaq action is actually the mechanism at work. Go, you good thing. The EWJ long put to January 2028 expresses Japan's energy dependence on Gulf transit and its internal economic and financial fragility. The SLV January 2025 $59 call carries the silver supply thesis, and USO shares carry the energy exposure through the blockade. And waiting, Palantir bear spread, waiting for the bounce into the 20-day, 50-day moving average band before selling calls into it. The SOX long put, the bromine helium story, we're waiting for the algorithm to confirm. DBA bull spread, the fertilizer cascade is reloading now. The blockade has returned. We're waiting. C variables, the street still isn't pricing. Now, I would doubt that much of what we are going to talk about on this slide will be in any of the Wall Street banks' notes to clients currently. When Micron fell 8%, every wire story said AX CapEx doubts. Not one mention of bromine. The Dead Sea flows that feed flame retardants and etchants for memory fabrication. Not one mention of helium, with Russ Lafan offline and no substitute in lithography cooling. The market is selling semiconductors for the wrong reason, which means the right reason is still unpriced. That's why the SOX put sits patiently on the waiting list. The same logic runs through fertilizer. Urea, ammonia, sulfur all transit Hormuz, and the reinstated blockade reloads the DBA thesis. And through silver, where the sulfuric acid export ban squeezes copper leaching, and with it byproduct silver supply, is in a sixth consecutive supply deficit year, while gold above $4,000 leads the monetary bid. And behind it all sits Taiwan's LNG reserve vulnerability, the transmission channel from the Gulf to the semiconductor heartland. Munger's lattice work. None of these facts is useful in isolation. Strung together on the theory, they're providing a map. So the verdict, the consensus is chasing the tape it wishes it had. The doctrine is positioned for the tape that actually exists. What we do, we're holding the active positions with their 50% GTC targets working. Let the waiting trade sparkle or stay unentered. Defined risk structures only. Conviction sizes the contract and the 21-day roll discipline. And because a thesis without falsifiers is a religion, not research, here is what could change our minds. A durable, verified reopening of Hormuz transit. The Cape compressed by earnings growth rather than by price. Fed easing without an inflationary acceleration. Or the semiconductors reversing on volume with algorithm confirmation. Should those arrive, Friar will change positioning without ego. Until then, we watch, and we'll watch others chase. If anyone's got any questions or suggestions for further research, I'd be very happy to hear it. Thanks. And just for the record, the references and sources used for this presentation. Okay, good luck to all, and do let me know if there's anything you'd like me to research.